guys like me, who said, Newmont is cheap compared to Agnico, would move down into Newmont or down into Kinross. Or if they didn't, the guys with lower cost of capital, which is to say higher share prices, would take over the smaller guys. What's been unique about this is that the whole process is accelerated. We have gone from the best of the best, the Francos, the Wheatons, the Agnicos, all the way down, even to the advanced explorers. And we've seen that happen in 18 months. That cycle through the rest of my career has taken 4 years, and it's interesting, and I don't really know why it's happened.
You're watching CapitalCosm. My name is Danny. It is September 25th, 2025, and my guest today is none other than Rick Rule himself, a big fan favorite who we're joy to have back on the show. Rick, thank you so much for coming on.
Pleasure being back with you. I enjoy these sessions.
Yeah, Rick, I mean, let us just dive, and I enjoyed them as well. But I also think a good chunk of our audience is enjoying this gold bull run that we're a part of now too. So let's get into it. What do you make of this recent run in gold? We consolidated for about 4 to 5 months since, from April to late August, and it appears we've hit another leg up in this precious metals bull market. Where are we at here? How are things developing in your eyes?
Well, two answers to that. Gold historically is extremely volatile. I think that the underlying trend in gold is up because I believe that the underlying trend in the purchasing power of the US dollar is down. But we've come very far, very fast. People who can't tolerate volatility need to consider taking some profits. I have no problem with volatility. I love volatility. I've been a beneficiary of it and a victim of it for 50 years, so it comes with the territory. If you ask me where we are in the gold bull market, really, I think we're very early on. I liken this to the decade of the 1970s. As we've discussed in earlier interviews, Danny, I believe it's likely that the US dollar loses ultimately 50 to 75% of its purchasing power in the next 10 years. Not relative to other currencies, but absolutely. The consequence of that is that I think gold trades higher. The shot that we've seen very recently, I think, is an advanced market indicator of the fact that investors and savers worldwide are very concerned about the impact of an interest rate reduction in the US. A widely telegraphed trade, and gold moved anyway. As the market digests that news, it wouldn't surprise me at all, given the near-term overcrowded nature of the short dollar trade, to see gold sideways to down. But if you have a 2-year time frame, a 5-year time frame, or a 10-year time frame, I think gold goes much higher. We were talking off the air about the gold equities, which is a different topic, and I guess we can cover them later in this interview.
Yes, and especially with gold, the way, I mean, the run that we've seen really began sometime in late 2023, I believe. So this is a multi-year run, and with the gold equities, it's simply a way to play. It's kind of like a leveraged play on the price of gold. So you want a little juice to some of the upside potential on gold. The equities are a way to do it, and it's also a way to provide a little extra torque on the downside should gold go down as well. So we're going to do something special this episode. We're going to cover the gold market, but then somewhere towards the middle, we're going to cover a few companies, and we're going to rank them according to your virtual ranking system. And then I want to talk about how you arrived at those rankings and, kind of provide the audience with a special offer that you guys have ready down the pike. But let's go ahead and continue with gold. You mentioned the Federal Reserve Fed funds rate being effectively telegraphed, to the point where anyone and their grandmother could see it. But yet gold not only rallied on the news, but rallied on the fact as well. It wasn't a buy the news, sell the event type of thing. It was buy the news and by the fact, by the event itself. Why do you think that is? What makes what we're going through right now so exceptional?
I think the reason is that the primary buyer of physical gold is still foreign central banks. Not your audience, not my audience, not Ma's and Pa's, but foreign central banks. You'll notice that right after the move, pardon me, right after the news, gold didn't rally because the retail buyer had bought ahead of time. The retail buyer had a look at the impending rate cut and said this would be good for gold. And when gold happened, at least for 2 weeks or so, that buying had been used up. But the foreign central banks, people who have to allocate billions of dollars in savings, looked at this and said, this is another nail in the coffin of the US Treasury market. And that's too dramatic a phrase. But this weakens the competitiveness of the US Treasury market. And as we've seen, really for at least 5 years, it has been disintermediation from US Treasuries into gold that has been responsible for the strength of gold. And that's continuing.
And so with these gold mining stocks, why do you think that they've run so early this time around? Historically speaking, these gold mining stocks take a while to ingest the price action in gold. This time around, they've outpaced the price of gold. If you look at the GDX, for example, and even in the case of silver as well, the SIL compared to the silver price, in both cases, you look at a year-to-date performance of either of those two ETFs, and they have outpaced gold by a wide margin. Why is that?
Traditionally, gold bull markets follow a very predictable pattern. The metal moves first. And that was certainly the case this time. In prior interviews, I remember that some of your viewers were expressing frustration. 2022 is an example. The gold price was moving, but the gold stocks weren't. There was then a simple explanation. Foreign central banks were buying gold, and they don't buy gold stocks. So a market that had a bid went up, and a market that didn't went down. But there's a second reason that's much more traditional. It takes a while for an increase in the gold price to translate into an increase in gold producers' operating margins. We began to see that in 2024, and we saw it expressed in the market in 2025. In a typical gold bull market, it goes like this: gold to the best of the best, the Francos, the Wheatons, the Agnicos, to the best of the rest, the Newmonts, the Barricks, the Kinrosses, to the junior producer, the single asset producer, the developer, the explorer. What's changed this time is that the whole process of the money moving down market has accelerated.
Mm.
What happened in the prior bull markets in my lifetime is that the best of the best moved first, and they attracted market multiples, market capitalizations that were excessive relative to the rest of the sector. And so valuation arbitrage would take place. Guys like me who said, Newmont is cheap compared to Agnico would move down into Newmont or down into Kinross. Or if they didn't, the guys with lower cost of capital, which is to say higher share prices, would take over the smaller guys. What's been unique about this is that the whole process is accelerated. We have gone from the best of the best, the Francos, the Wheatons, the Agnicos, all the way down, even to the advanced explorers. And we've seen that happen in 18 months. That cycle through the rest of my career has taken 4 years. And it's interesting. And I don't really know why it's happened. Perhaps it happened because that sector was so ludicrously oversold. Perhaps it happened because life of cycle bottoms in 2021 and 2022 were farcically low. And what we've seen in the juniors is a dead cat bounce. I'm not sure what we've seen, but what I have seen is that the best of the juniors have all taken advantage of these higher prices to come to market to raise capital. And for the best of the juniors, all of these capital raises have been substantially oversubscribed, which tells me that the money is present in this bull market, and the gold bull market is really, truly underway. It also tells me that investors need to be more careful. If the price of a company doubles without any change in the fundamental news around the company, it is, of course, half as attractive as it was before the price doubled. And so people need to pay attention to that. They are no longer in the easy money part of the cycle. The easy money part of the cycle is when companies go from being hated to being tolerated. And gold is certainly no longer a hated asset class.
No, not at all. But what is a hated asset class or something akin to it is energy and oil. And now oil has been relatively subdued this entire time
Yep.
while gold has been moving up, which translates to a widening in margins by proxy, right? Because oil, you could
Right.
look at it, you could view it as the proxy for the input costs, and gold itself is the revenue generating asset that these companies, mine. And so as one stays constant while the other moves up, or in some cases when one starts going down in the case of oil, I mean, has this not occurred before in previous gold bull rallies where energy prices have gone sideways to down while the gold and precious metals prices have gone up?
Yeah,
Is this
that's not necessarily inconsistent philosophically.
mm,
Oil prices often move as a consequence of broad economic trends. A soft economy on a global basis often stimulates quantitative easing, which is a fancy way of saying counterfeiting. The government response to a soft economy is often printing phony currency, which is good for gold. It doesn't always happen, but you bring up an interesting point in that it's likely that speculators and investors with a strong constitution need to begin to allocating substantially more resources in the oil space, which is hated or at least ignored.
mm.
Um, Investors who are more momentum oriented and traders definitely want to be in the gold space because now you're in the way of the money. And it's worthy to note that although the gold trade is attractive to you and I, given where we've been, most investors can't spell gold. It is not a crowded trade if the crowd that you're talking about is the generalist investor. The generalist investor, as is evidenced by money flows into gold oriented and gold equities oriented ETFs, is still very constrained. The gold equities ETFs are increasing in net asset value because the gold price is going up. In fact, they're experiencing a negative flow of funds. So this is a story that likely has legs, albeit it's a story that's going to be very volatile.
Did you hear about this Morgan Stanley? I can't remember who he was. It was some executive at Morgan Stanley that recommended a a remix or a venture out of the typical 60-40 into a 60-20-20, 60% stocks, 20% bonds, and 20% gold. Gold has been severely underallocated for the past few decades. What does it mean when serious investors like that begin allocating 20% of their portfolios into gold?
Well, to put that in perspective, Danny, um, the last statistic I have was from J.P. Morgan Chase, and J.P. Morgan Chase said that the overall the global allocation to precious metals and precious metals equities in the U.S. was only 0.5%. Put specifically, 0.5% of the total savings and investment assets in the United States are allocated to precious metals and precious metals equities.
Mm-hmm.
That's down from a 4-decade mean of 2%. So if the allocation merely reverted to mean, you would have a fourfold increase in demand.
Mm-hmm.
I have no idea what a
20%.
20% market share, which would be a 40-fold increase in the allocation would do. I don't think it will occur, to be honest with you. Uh, I don't think a 20% allocation, given what I see to be the certainty, the inevitability of a decline in US dollar purchasing power, combined with artificially low interest rates. I don't think in that circumstance that a 20% allocation is out of line. Think about the arithmetic of the competing instrument, which is certainly the US 10-year Treasury. If inflation continues at its current pace, and by the way, inflation should not be measured by the CPI. If inflation maintains its current pace, which I think is closer to 8%,
Mm.
and the interest on the US 10-year Treasury stays at 4.5%, What that means is that gold's competing instrument, the US 10-year Treasury, guarantees that you will lose the delta between inflation and the interest it pays, which is to say 3.5% a year for 10 years. In other words, in the US 10-year Treasury, you're guaranteed by the US government that you will lose between 35 and 40% of your purchasing power over 10 years. That's pretty constructive for gold. So that, pardon me, that 20% number is a very interesting number. I don't think it has a hope in hell of occurring, but I wouldn't necessarily discourage it, particularly given what I consider to be the certainty of challenges around the US dollar maintaining its absolute purchasing power over the next 10 years, which I consider the probability of to be nil.
Is that something you would do, Rick? Would you allocate 20% of your portfolio into gold?
If you look at my own portfolio now, first of all, somebody who looked at my portfolio would say I'd be a moron to own physical gold. Because as an example, I'm the largest shareholder of Sprott, a brand name for gold.
Mm-hmm.
My allocation to gold and gold equities is higher than 20%. But that's partially because of my economic prejudice and partially because I've spent 50 years coming to understand the gold bull market. For me, it's at once an investment, a speculation, and a vocation. I do all those things. I wouldn't encourage your audience, most of whom have lives, to be as over allocated to gold and natural resources as I am. But that's what I do. If you have a listener who owns a plumbing company, he or she focuses a lot of their life on running a plumbing company. In addition to being a philosophical adherent to gold, my plumbing company is a gold financial services business. So I'm way over allocated relative to the norm in precious metals and resources.
Right. And so when you're out there looking for these mining stocks to buy into, I mean, you have your own set criteria, obviously. And this October 4th, not this Saturday, but the Saturday after this Saturday, you're hosting your part 3 to your Popular Gold boot camp. Walk us through what people can expect at that boot camp.
Well, first of all, you can expect to work very hard. This is not an entertainment product. For that portion of your audience who buys the newspaper for the funny columns or the crossword puzzles, this is not the right place. Over 8 hours, we're going to work you extremely hard. We're going to record the proceedings, and you're going to have access to the proceedings for a year. And you're going to need to play the recordings probably twice more after hearing it. So you need to be prepared to devote 20 to 25 hours to the boot camp. If you're not, don't show up. Simple as that. If you are serious about learning about gold and gold equities, do show up. This is the third, as you suggest, of a 3-part series. The first boot camp, the tapes of which are available for purchase, we covered gold itself and how to own it. Physical gold, why you own it. Gold is a topic. Gold is savings. The second, we covered the best of the best, because in gold bull markets, the momentum has always gone from gold itself to the best of the best to the best of the rest. So we've done gold and we've done the best of the best gold equities. Those are the first 2 parts of the series. The third part of the series is where we are in the gold bull market now, when the best of the best have run, when gold is run, and where the money is coming down the rest of the circle. When people come to understand the value proposition and they begin to act on their understanding. The faculty that we're going to have this year for this boot camp is going to be outstanding. In addition to myself, a fairly veteran investor and a fairly veteran educator, we're going to have John Hathaway, who has been a leading gold industry investor for 45 years. Not somebody who failed as an auto analyst, failed as a supermarket analyst and parachuted down in the gold space where he couldn't do any damage, but rather somebody who's made money for investors through good years and bad. He runs the gold equities business for Sprott, which is a brand name in gold. Superb guy. We have Adrian Day, who has been a co-investor with myself since, if my memory serves me well, 1988.
Mm,
Another really truly veteran gold industry investor. We have Lobo Tigre, who does a great job in the junior space. We're just going to have a great faculty. But I would say, one more time, for those investors and speculators who are not really focused on working hard and learning, don't come. If you are focused on working hard and learning, you are going to get 8 hours worth of work, 50 or 60 hours worth of knowledge. Uh, as with all of my investor education products, anybody who pays the course fee who isn't satisfied can simply tell us, and they get a 100% refund. No questions, no conditions, except that you have to attend. If you pay me to attend and you don't attend, and then you want a refund, too bad, so sad. You have to have showed up and at least attempted to participate. We've had this offer in place for 30 years. We've had to refund about 0.1% of the tuitions that we've charged over 30 years. But it
wow.
remains your guarantee that we're comfortable enough with the contents of our programs that we can offer an unconditional money back guarantee.
Fantastic stuff, Rick. We will have a special link to that down below. And from what I can gather, this is really a way to teach the viewer how to fish and not just give them a fish. Although
Correct.
we're going to transition into giving them a fish here in a second by going through some of these gold rankings, but nonetheless, it would be a great service to the audience to, to consider joining the part 3 of the boot camp to really understand how to pick these stocks yourself and not be so reliant on hot tips and hot picks that you read in various newsletters, but just really be efficient. So I highly encourage you guys, check out the Gold Bootcamp Part 3, which we will have a link in the description and pinned comment down below. So all right, Rick, let's go ahead and dive into some of these rankings. But before we do, quick disclaimer, guys, these rankings are merely a snapshot in time. It is September 25th, 2025, meaning that come September 26th, 2025, the rankings are subject to change. So given the conditions of the market. So Rick, explain to the audience, for those who may not be familiar with your rankings, how they work from a scale of 1 to 5.
Oh, any of your listeners are free to go to the Rule Classroom, which is free, and play Introduction to Natural Resources. The tapes, where there's 6.5 hours of instructional programming that basically lay out the guidelines of the rankings. We are interested in the delta between what companies are selling for, which is to say their enterprise value, and what they're worth, which is to say their net present value. We overlay a few variables. One, our opinion as to the direction of the underlying commodity price, which impacts net present value. Our impression of the management's specific skill sets around maximizing the return on capital employed, but also recycling the free cash flow from existing production into growth. And we attempt to measure various types of extraneous downsides, political risk, social risk, that type of thing. We are pretty uninterested in technical analysis. We are pretty uninterested in momentum. The real discipline that we follow is deposit quality, net present value, probabilities of growth, but most importantly, the discrepancy between price and current value and expected value of the deposit. Very much bottoms up, fundamentally oriented. We look particularly for deposits, whether producing or not, that will be in the lowest cost quartile in their commodity type worldwide. We also look for deposits that will be in the best quartile in terms of profitability measured by return on capital employed in their sector worldwide, but at least 25% return on capital employed. We are particularly attracted to companies that are in commodities that are out of favor. hated, which are often cheap. The easiest money to be made as a speculator is in a sector where it moves from unloved, read uranium 14 months ago, to tolerated or even liked, read uranium today. So our rankings for out of favor commodities, nickel as an example, are higher than the streets. Our rankings for commodities that are decidedly in favor are often lower than the streets because remember, we don't penalize for volatility, and we are interested in absolute discrepancies between net present value, expected net present value, and price today.
Understood. So how do the scales work?
Actually, I should say we're doing 1 to 10 these days
One to
to
10.
add some nuance. To put it in perspective, I've had 11 one rankings, which is my top ranking, in 35 years of ranking stocks. A one means that I have to believe that the company is selling for half of current net present value. I have to also believe that net present value could reasonably easily grow tenfold in 5 years. I have to believe that there is a catalyst in place that will increase my expectation of net present value by 100% in 2 years or less. In other words, I'm expecting a 2-year double at current commodity prices, and I have a reasonable expectation of a tenfold increase in 5 years. But a tenfold increase in 5 years where the company is already selling at a 50% discount to current net present value. That's a pretty rare crowd. The consequence is I've had 10 or 11 of those in 35 years. A 10, by contrast, is a company where I would suggest that speculators, at least, establish substantial short positions, where I think that there is a probability that the company will be bankrupt within 2 years, not salvageable. Mostly the very poor companies, the companies 7 or below on the scales, I don't bother to rank. There are something like 4,000 public oil and gas and mining companies worldwide. We follow about 800 of them.
Mm.
And the companies that are on the very poor end of the scale, we very seldom rank because there's no particular reason to follow them. We only follow them if they're heavily promoted and widely owned. So that we think within our audience in rural investment media is about 90,000 people, that there is a reasonable reason for us to spend the time and treasure involved in generating a lousy ranking, a 7 or an 8.
Understood. So let's go ahead and dive right in with.
Let's do it.
And this is going to be rapid fire. So let's start off with Alamos Gold.
Alamos Gold I have as a 5, which is a fairly high ranking at this point in time in a bull market. High quality company, high quality free cash flow, high return on capital employed, low costs, and a reasonable recycle ratio. The only caution I might have is that a lot of the company's growth, the direction, has come from a guy named John McCloskey, who I've known for 40 years, which suggests he's as old as I am. And one wonders about the durability of the CEO. He's made some mistakes which I've disagreed with in the past. Not mistakes, pardon me. He's made some decisions which I haven't agreed with in the past, and he's been right, and I've been wrong. Superbly run company.
Oh, come on, Rick. 40 is the new 30 now. You're not that old.
Yeah, but 70 is problematic. both John and I are older than some of the deposits he's mining.
Oh, interesting. Well, on that note, let's go to Alistair Gold.
I haven't done enough work recently on Alistair to comment, so I'll leave that out.
Gotcha. What about Buenaventura?
Buenaventura, I personally have as a 4. You need to be willing to take substantial political risk with Buenaventura. They operate primarily in Peru, and the political and social risks in Peru, in addition to being well documented, are also real. If you want to be in the silver space, and I think we're in the very, very, very early innings of a silver bull market, you need to consider Buenaventura, Peñoles, Fresnillo, the Latin American, Peruvian, or Mexican miners. But you face real social and political risks with these companies.
I see. Core mining.
Core mining, I have as a 6. I think they're going to be. I think they're going to perform very well in the near term. My concerns around Core are the fact that they have already performed extraordinarily well, and they've performed well as a consequence of an increase in free cash flow that came about from their acquisition of an existing producing mine, which is generating tons of cash, but has a fairly short mine life. If the management team isn't able to allocate the cash flow from the Silvercrest asset in an accretive fashion, you're going to have some ugly surprises there because it's trading on a high free cash flow multiple where the free cash flow has a short reserve life. So I'm concerned about Core. I don't own Core.
Endeavor mining.
Endeavor Mining, I own. You have real political risk here. They have done an absolutely superb job of building the company over 25 years with frontier exploration and development in French West Africa. French West Africa is undergoing severe uh, social and political change. It's also important to note that the team that built Endeavor Mining, the financial team, is now in South America building Aris Mining, which is to say the people who led the growth are gone. And the mine building team, at least one of 2 mine building teams, is now at Montage Gold. So, whereas in normal circumstances on a valuation basis, I might even have Endeavor at a 3. The consequence of management turnover is that I have it at a 5.
I
On a
see.
valuation basis, it is cheap.
Gotcha. So you mentioned Agnico. So let's go ahead and get Agnico's ranking.
I have Agnico as a 4. Reasonably, I probably should have it as a 3, but everybody loves it. It is no longer cheap. It is the gold standard of producing companies. They haven't made a misstep that I'm aware of in the last 5 years, and growth is baked into the cake simply because of brownfield expansion. The next 5 years production growth is in shape. I had the good fortune at my conference in Boca Raton and then subsequently at the Rural Classroom of interviewing Amar Al-Jundi, only the 3rd CEO in the company's long, proud history, and a wonderful, wonderful human being. It's a must-own gold stock. Newmont is, I would say, the rebound story, the Cinderella story in the gold mining sector. They had 9 straight quarters where they disappointed in terms of all-in sustaining costs. They did a large acquisition, and of course, the company was built by acquisition, which is why Goldcorp is part of Newmont. And the consequence of that acquisition is that institutional investors asked them to sell off all of their second-tier mines. They've largely completed that task. They budgeted receiving $2.2 billion. They've received $5 billion with contingent payments coming. They've cleaned up the balance sheet. But more importantly, they have now controlled all-in sustaining costs. Rather than having their time and sustaining capital consumed by 20 mines, they can focus all their love, care, and attention on 8 mines that matter. So with regards to Newmont, I currently have them at a 5. I would have them at a 4, except for the fact that the stock has basically doubled in 18 months.
All right. Well, what about Hecla? Hecla Mining.
Hecla, I have as a 6. Again, I think it's a stock that's going to perform. My ranking is really a function of the dichotomy between price and value. I don't own Hecla, but I think we're headed into a silver bull market. And very much like Coeur, Hecla is a brand name for American investors in silver. So although I have it ranked poorly on a valuation basis, speculators should consider owning the stock as a proxy for silver equities.
And Kinross Gold?
Kinross, I have it as a 5. They have done a great job of implementation, but the market has noticed. The thing that really drove them down, which was the performance of Tasiast and their overpayment for Tasiast, has worked through the stock. Tasiast as an asset is really starting to work and it's generating a lot of cash. They've done a reasonable job. They have a great deposit in the Canadian Shield now to build. They have the cash to build it. They are very good at northern construction and operation. The only reason I don't have them ranked higher is that the market has already noticed their virtues and bid them up.
Mm. And what about McEwen Mining?
McEwen I have as a 5. That might be an aggressive ranking. I own the stock. I'm a big fan of Rob McEwen, whose name is on the door. I'm ironically particularly attracted to their, I believe, unnoted holdings in an affiliate, McEwen Copper, which is one of the 10 largest undeveloped copper deposits in the world. Rob McEwen is an astute allocator of capital. He is a very good motivator of employees, and he is also an absolutely deadly promoter. He is the kind of person who will reawaken a constituency in a gold bull market, which I believe we're in.
And what about Newcrest Mining?
Newcrest has disappeared into Newmont. Newcrest has been taken over.
Gotcha. And we already covered Newmont.
Yep.
Pan American Silver.
With the caveat that I have a large position in Pan American Silver. You're talking about real conflicts of interest now. Pan American's in a sweet spot. I would suggest that they paid a very, very full price for MAG, but the consequence of that is they got a 44% interest in a spectacular silver deposit. The problems that they had absorbing the prior acquisitions, as an example, the Tahoe acquisition, surpassed them. They bought those assets at a much different gold and silver price. And they bought some assets that had been, I would argue, cash cows, stripped of cash. And they needed sustaining capital investments and focus in terms of time and attention. That's happened. And I believe now that Pan American is coming into a real sweet spot. Despite the fact that well more than half of the revenues are from gold, this is still widely regarded in the market as a silver stock. And if I'm right about the near-term direction of silver equities, Pan American will benefit from that.
All right, so we're gonna do a bonus round. I'm gonna bring up 2 platinum companies here. I want to get your thoughts on because we haven't talked about platinum yet. But what do you think of Stillwater Sibanye?
I don't have the courage to own it, despite the fact that the CEO is a friend of mine who I've done business with for 35 years.
Mm.
Love the platinum business, but I think the political and social risk in South Africa, where a lot of their production is understated. And the consequence of that is that I don't own Sibanye Stillwater. I had it as a 5 when platinum was hated. The platinum price is up by 40%. So I now have Sibanye as a 6.
And what about Platinum Group Metals, PLG?
I don't own it. I don't follow it well enough. I don't rank it.
Gotcha. Well, Rick, this is this has been a small taste of some of the ideas that one can learn at the Gold Boot Camp coming up. So if you want to be able to learn more and learn how to fish and think in the same way that Rick Roll does, then I highly encourage you guys to check out the boot camp, which we have a link down below. Rick,
Understand that financially, that's a riskless transaction. If you don't think for any reason that you didn't get your money's worth, you get your money back. You won't get the time back, but I would suggest it's time well spent.
yeah.
One thing I'll say about the boot camp is it's meant to be enjoyed in conjunction with the Rule Classroom. The best way to reach there is probably ruleinvestmentmedia.com or ruleclassroom.com. At ruleinvestmentmedia.com, I can shortcut all this. Go to ruleinvestmentmedia.com, list your natural resource stocks, and I'll rank them for free, no obligation. At the Rule Classroom, there's a couple hundred hours of instructional programming, including Introduction to Natural Resource Investing, which will teach you how to do your own rankings. You likely won't do them as well as me because I have a whole staff and I spend a lot of time on it. But the truth is, you won't have to take my word for it. So yes, by all means, go to the Rule Classroom. Yes, if you're willing to work and you are serious about gold industry investing and speculating, by all means, attend the Gold Boot Camp. One more time, the disclaimer: if you're the kind of person who buys the newspaper for the funnies, for the crossword puzzles, don't come. This is hard work.
Yeah. But if there was ever a time to work hard in understanding the gold and silver mining space, and gold in particular for this boot camp, it's now. I mean, we see gold making new all-time highs almost daily now. I mean, this is the time. It's now or never. So if you're ever wanting to dip your toe into the gold mining space and really understand how it works, now's the time.
Danny,
And
the value inherent in the boot camps is evidenced by the fact that thousands of people have attended them. And about 0.1% of the attendees have asked for refunds. We've had boot camps where over 5,000 people attended, and where 15 or 17 people asked for refunds out of 5,000 attendees. That speaks absolute volumes to the value offered up for people who are serious about learning how to invest in natural resources and precious metals.
yeah. And this is it. I mean, this is it, guys. Doesn't get any better than this. I mean, it's served to us on a silver platter, no pun intended. So, Rick, it's been a pleasure having you on, my friend. Where can people get in touch with you? Where can people find you if they want to see more of your work?
Best place to find me is Rule Investment Media. And as I say, I make it worth your while. Go there, list your natural resource stocks. By the way, please no crypto, please no pot stocks, please no tech stocks. List your natural resource stocks, and for no obligation, for no charge, I'll rank them 1 to 10. I'll make comments on individual issues like I did today in response to Danny's questions, where I think my comments might have value. Once again, ruleinvestmentmedia.com.
Excellent. We'll have that link down below. So check it out, guys. And if you got value out of this podcast, drop us a like and comment "Go Rick Go" in the comment section. If you agreed or disagreed with anything we talked about, that's fine. But let me know what you agreed with, what you disagreed with. I do, in fact, read all the comments, good or bad. So drop me your thoughts down below. I will try to respond to a small handful of them, but I won't be able to get to all the comments. But nonetheless, I will read them and subscribe to the channel so you don't miss an episode. And by liking, subscribing, commenting, doing all the YouTube stuff that I tell you to do, that does help us in boosting this video and this channel up in the algorithm. So if you'd like to support us, this is a free, easy way to do so. And it may not seem like much, but a little bit does go a long way in helping boost this channel in the algorithm. So much appreciated for your help here, guys. But if you'd like to take it up another notch, then of course consider subscribing to my Substack at capitalcosm.substack.com to get access to all of my videos early before the YouTube audience does, ad-free and uncensored for videos that warrant it, as well as the chance to ask my guests questions down the line and make guest recommendations. So with all that said, I appreciate your time, guys, and I will catch you later. Bye.